Now we'd like to apply these tools to understanding bond pricing. So a bond is nothing more than a promise to pay a certain amount at a future date. And you're trying to find out what the price a bond should sell at today. So in other words, you're solving for the present value, knowing a particular future value. A bond that has an initial interest rate of 10% and a future value of $100 will sell for $90.90. Okay, this is using the same numbers as in the previous file. If the interest rate falls to 5%, it'll sell for 100 divided by 1.05 or 95.24. So at a higher interest rate, the bond sells for a lower price. Okay, bond prices and interest rates are inversely related. Very important fact about financial markets. Now, it's important to think about the idea of there being an interest rate that is common to assets that have similar levels of risk. So if this bond that we're talking about is a low risk bond, by risk I mean the probability that the money will actually never be repaid at all, that there would be this called a default on the bond. A low probability of default means low risk. High probability of default, high risk. So if the bond is a low risk bond, then you want to compare, you're going to say that its interest rate in equilibrium should be the same as the interest rate of similar low risk assets. So when we say that a bond has an initial interest rate of 10%, it means that the equilibrium interest rate in the market for this class of financial assets with similar risk is 10%. Of course, risk assessment is subjective, and markets change their assessments of risk for different securities over time. So that means that the prices of bonds can fluctuate if the interest rates fluctuate for bonds or for assets of that risk class, or if the bond itself is reassessed to actually belong in a different risk class. Okay, if you say, oh, I thought this was low risk, but now I actually realize it's quite high risk. It's similar to what happened to some of these mortgage bonds in the financial crisis. So the buying and selling of equally risky assets is called arbitrage. And the rate of return on a bond is determined by applying this present value formula. 1 plus r is equal to the future value divided by the present value, 1.1. In this case, $100 divided by 90.90, 1.1. So we'd say this bond has a 10% rate of return, and assets with similar risk would also be earning 10% rate of return in equilibrium. Okay, and this is the main conclusion here about investors are going to compare rates of return on alternative assets of similar risk, and the buying and selling of these assets will tend to equate the rates of return across equally risky assets. For example, if the rate of return on the first asset is greater than the rate of return on the second asset, and we believe they have similar risk, well then people would tend to buy asset 1 and sell asset 2. Then the price of asset 1 would rise, therefore its rate of return would fall. The price of asset 2 would fall, and the rate of return would rise. Remember, prices and interest rates, prices and rates of return are inversely related. Okay? Low price, high rate of return, high price, low rate of return. Arbitrage is this process of buying and selling assets of similar risk until their rates of return equalize.